I'm Caroline Hyde. This is Bloomberg Technology. Coming up, JP Morgan CEO Jamie Dimon weighs in on the debate over visas for skilled workers. And US tech giants realize President Trump's changes to H-1B program might help them. Plus, Indian outsourcing companies sink as Trump bears down on tech visas, but India is still a big bet for US tech giants. We explain why. And add cash crunch to the list of Lego's growing pains. We look into the Chinese tech conglomerate's long list of problems. First to our lead. The concerns continue over the latest H-1B visas guidelines. JP Morgan CEO Jamie Dimon weighed in on the debate, keeping highly skilled workers in the United States. Now, in his annual letter to shareholders, he explained that it is alarming that foreigners who obtain advanced degrees here cannot stay stateside. Quote, "We are forcing great talent overseas by not allowing these young people to build their dreams here," said Dimon. Now, these remarks come just days after President Trump made it harder for companies to use H-1B visas. Critics of the program, like the president, say, well, the H-1B visa allows outsourcing companies to bring in lower-paid foreign workers. But these latest changes might just help US tech giants, interestingly. Here to dig into this is Bloomberg's Corey Johnson, and from Washington, Ron Hira, associate professor at Howard University, who's done extensive research into the H-1B visa program. Gentlemen, welcome. Corey, first to you, because I want to backtrack a little bit and just remind ourselves of really why there is so much kickback against the H-1B visa and how much it seems to help certain Indian outsourcing companies in particular.
Well, first of all, you're right. The concentration is very much greatly on Indian workers, bringing Indian workers to work in these temporary jobs in the U.S. And the perception of that is if you want to have American employment and American employment in high tech is terrible. But on the other hand, it is providing U.S. companies with workers they just can't find anywhere else. The companies have to demonstrate that in order to get these workers. You know, these aren't new conditions the Trump administration is really adding here. The American companies have always had to show that the people they're bringing into the country are getting paid. They've tried to find American workers, that they posted a job, and that the pay is better than or similar to what an American worker would get if that person was available.
I mean, it seems as though the share price has reacted on the back of this. We've seen Tata Consultancy Services fall today. We saw Infosys fall today. I just want to jump into my Bloomberg here. If you go into the BTV graph library, 7468, type it in, Infosys, already in a world of pain, because as you'll see, since 2016, as we'll see just from the top of the peak in 2016, we've gone down about 10% in terms of the share price. Meanwhile, open interest, futures open interest, have been spiking to the highest since 2008 ahead of their earnings. This is really starting to show a bit of bearish sentiment, significant bearish sentiment, really riding in on the software maker in India. I want to bring in Ron Hira now, Associate Professor of Howard University. You have written long and at length and real with expertise about the outsourcing question. These moves that have been made to the H-1B visa, are they making it slightly tougher for the outsourcing companies in particular, or does it make it harder overall to bring in the talent that's necessary in the US?
Well, I'll take a couple of things. One, really it's focused on enforcement. And as long as the firms are complying with the law, this really doesn't make any difference at all to those firms. So if they're violating the laws and the rules and the regulations, then they may be in trouble. If they're not, this is just an enforcement mechanism or measure. And I would unfortunately disagree with Corey Johnson's characterizations. In fact, you do not have to show that there's a shortage of American workers. You do not have to recruit American workers before hiring an H-1B. In fact, you could prefer H-1Bs over American workers and replace American workers with them. You can also legally pay them much less than a U.S. worker, as much as 40% less, and we have documented cases of this.
And I'll agree that's where the worst abuses have happened there, and they have a lot of the outsourcing companies have been accused of this. And when you look at the list of the most used, the companies that use these the most, yes, you see Tata, and yes, you see Infosys, but you also see New Jersey's Cognizant is chief among the companies using these to bring in workers into the U.S.
And at a cheaper price point, we've seen that there has been a slightly lower wage being offered because they are entry-level jobs. I want to take it out to Ron, because therefore, what would you propose could be done to change the H-1B that would mean that US companies, and indeed outsourcers, whoever needs the tech talent most here in the United States and are willing to pay for it, can get their hands on the right talent that they need, even if it is indeed necessary from abroad?
Yeah, so absolutely the intent of the H-1B program is a good one, and that is to fill skills gaps when it's hard to find U.S. workers and to bring in and keep the best and brightest. So that rhetoric is correct, and that's a good thing. The problem is right now the rules are so loosely written that it's extraordinarily easy to bring in workers at much lower wages, and it's extraordinarily profitable. And so what you've got is you've got firms that are gaming the system that have essentially built their business model around cheaper H-1B workers. And it's quite easy to fix this. We know how to do it. We know what the problem is. It's basically you've got to raise those wage floors so that workers are being brought in not because they're cheaper, but because they are truly the best and brightest and have some skills that U.S. workers don't have.
But can every entry-level engineer, programmer, who might be from the United States or indeed educated in the United States, really vindicate more than $100,000?
I'm sorry, so $100,000 is sort of misreported about what those salaries are. The way the minimum salary works is it's based on the geographic location, the occupation, and the skill level. And so no one's talking about a minimum wage of $100,000. What we're really talking about is allocating the visas based on the highest wages. So that would be one way to do it. If you really want the best and brightest, they should be paid like the best and brightest. And if you want to allocate the 85,000 visas, do it based on the highest salaries. And then that would squeeze out the firms that are using it really for the cheapest labor. It would help the American economy. You'd be bringing in the best and brightest, and it would be a fairer system in a lot of ways.
And it does seem, and Ron, you know more about this than just about anyone, it seems that it really is, there was a bifurcation the way that it's used, that there are a lot of companies, as I mentioned, Tata, Infosys, Cognizant, using it as body shops almost, and then you have companies who use it much less, but companies like Intel and Microsoft and Apple and Facebook and so on who really seem to be looking for best and brightest. Is that a fair characterization?
Well, I'm not sure I would characterize it that way. I think it's definitely there's business models that an IBM and Accenture and Infosys, they all have the same kind of business model. And by the way, they're selling to J.P. Morgan. So it's a little bit disingenuous for Jamie Dimon to be talking about this when he knows that he's hiring these firms to basically undercut the U.S. market. But certainly some of the best and brightest are being brought in and they're being paid fair wages. The question is, how do we monitor that and make sure that all firms are doing this in that way? And targeting just outsourcing firms is the wrong way of making policy. You should make it so that no firm can pay low, cheap labor. All firms should be looking for U.S. workers first.
And indeed, whether 85,000 cap will be reached soon, and we'll see whether perhaps making it slightly more stringent will make it easier for the likes of Intel and Microsoft to get their hands on the right sort of people going forward. Ron Hera, Associate Professor at Howard University, we thank you very much for your time live from Washington. Meanwhile, Bloomberg's Corey Johnson, expertise valued here as always. Now, as we mentioned, and as Ron was just mentioning there, JP Morgan CEO Jamie Dimon also weighed in on his annual letter to shareholders, and among the highlights, well, the bank spent more than $9.5 billion on technology last year. Bloomberg News reporter Laura Keller covers the big banks and joins us now from New York. $9.5 billion. Did we get a breakdown of exactly where this money's being put to work by Jamie Dimon?
We did. I want to bring up my notes here really quickly for you, Caroline, because he did give us a breakdown on that $9.5 billion that was spent in 2016. I believe he had said something around $300 million or so for what he would refer to as fintech initiatives, so the sorts of things that do compete with startups. And I just want to mention too, it's just such an abrupt change from Jamie Dimon over, say, the last 2 years, because if you go back to his 2014 letter, he was saying there that we should be worried about Silicon Valley, that Silicon Valley is coming for the financial industry. And last year, he had a different tone, is much more optimistic. And this year, of course, part of his letter is spent touting the different initiatives that the bank does have going on the fintech front.
I mean, absolutely fascinating. Into $3 billion on new initiatives, as is saying, $600 million being put into fintech companies in particular and ventures with them going forward. Laura, is there any idea how long this will be continued? You said, of course, in previous years he had said that tech is coming for the financial giants. So is this sort of level of spending going to be continued?
I mean, he didn't give any projections to say what he'll be spending next year, but he certainly looks at it as something that the bank needs to continue investing in. He's saying, look, if we don't have that investment, we're not going to be growing as quickly in the future. And he definitely considers the company to be, in part, a tech corporation. And, you know, from that perspective, he couldn't possibly stop spending on on technical ventures.
And neither can competitors out there as well. I want to draw our viewers' attention to the T-Live Go function that you can use on your Bloomberg, where Laura Keller and her colleagues write brilliant analysis when we get such reports as this. You can dig into Jamie Dimon's annual letter to JP Morgan shareholders, teaching us all of the key takeaways, as well as the updated numbers that we got. Laura Keller, thank you very much for your time today. Now, coming up, we give you a peek at a new index that could give startups seeking funding an upper hand. That's next. And a reminder that all episodes of Bloomberg Technology are now live streaming on Twitter. Check us out. It's at Bloomberg Tech TV, weekdays, 5 p.m. in New York, 2 p.m. right here in San Francisco. This is Bloomberg. Now, when is the best time to fundraise? It's a major question almost every startup faces, and one a new index wants to help answer. The Goodwater Index aims to help consumer-oriented startup founders better understand the venture capital fundraising environment. It's created by the early-stage venture firm Goodwater Capital in the hopes of shedding light on private market investor sentiment. Joining us now to discuss is Chi-Hua Chien, who's co-founder and managing partner at Goodwater Capital. Wonderful to have you here to shed a little bit of light on this very murky area that is VC funding. And first of all, this is a data-driven approach. What data points are you taking to fill this index that you now have built?
Right, so we looked at a variety of public and private data sources and back-tested them against 20 years of history to see which ones are most predictive of fundraising sentiment. And the ones that we ended up with are IPO, M&A, VC funds raised, deal activity, and ultimately the PE at which public companies are trading. And when you put all those together, you get an index which is highly correlated with the sentiment of Sand Hill Road.
I mean, we at Bloomberg have a Bloomberg US Startups Barometer. I can show it on my Bloomberg right now when you type in B Startup Go, and it's showing that actually things are a lot better than they were 2012, 2013, but they're perhaps not at their peak that we saw back in July 2015 or even earlier at the end of 2016. Yeah. Are your funding statistics and barometer and index that you have built at Goodwater showing similar themes at the moment?
Yeah, it's very similar. So we saw that the market peaked in 2014, continued through 2015, and then took a big dip from 2015 down into the end of 2016, a 30% drop.
And why?
Well, there were a number of factors. One, the market was overfunded, but specifically LinkedIn, by dropping 43% in one day when they guided lower, led to a chill in the startup funding market for about 3 quarters, and that had a huge impact.
I see. What also fascinates me is the fact that this is very much aimed at consumer-oriented startups.
Yes.
Does this have no relevance to the B2B, to the enterprise startups out there?
Yeah, we focused on consumer because that's what Goodwater does. We're consumer tech investors. But we do think it is generally indicative of the overall startup funding market because it's those same partnerships that are funding consumer companies and enterprise companies in many cases on Sand Hill Road.
I think it's also interesting that you say you help bring recommendations when it comes to actually going out there and doing your startup funding, when it comes to terms, when it comes to due diligence you're going to be needed to do. Terms, are they in the hands at the moment of the VCs or are they in the hands of the startups?
We think right now it's balanced. So we have a 4-level scale and right now it's go for it, which means that it's a healthy market. It's not a bubble. It's a healthy market and terms are balanced. And this is something that we observed in 2016 was a real problem because companies that had raised money in 2014 or 2015 thought it's so easy to raise money, no problem. And I've grown 4 or 6x since the last time I raised money. But the market dropped by 30%. Yeah. So think about it, if you were a public market investor, if the Dow dropped by 30%, you would have your hair on fire. You would think it's a completely different ballgame for investing. And that's what we're trying to educate entrepreneurs on, is in a shifting market, the terms and the timing are going to change a lot.
And the players, Because we've seen more
Absolutely.
entrants wanting to come into later stage funding, the big institutional players. How has that changed all the landscape?
So during 2014 and 2015, you definitely saw that. You saw a lot of foreign money, you saw hedge funds, you saw public market investors shifting into the market. And in 2016, they all cycled out, which led to a cooling trend as well. And it led to a lot of challenging financings that were, some of which were widely reported for growth stage companies.
So if I'm looking at your particular funding index, would I also be gauging any sort of global sentiment here? Because we are seeing companies going to Chinese investors and European investors. Yours is very much a US-based one.
That's correct. Our data is US-based. If you were to look at the world ex-China, we think it's highly correlated to that sentiment because a lot of global companies come to Silicon Valley to get funded. China is really its own beast. It has a very healthy funding ecosystem, has a very vibrant venture capital market, and those trends don't necessarily correlate highly with what's going on in the US.
So Chiwa, I'm a startup. I'm coming to you at Goodwater, looking not only for your expertise as when to go to raise funding, but if I wanted money from you as well. What would I be saying to you right here, right now, what would you think the VC market wants to see out of the startup community right now? Is it revenue? Is it proven revenue? Is it cost discipline in some way?
So we have a specific recommendation, which is that you want good growth, but a reasonable business model. Because the period of time when things that were just growing quickly with no business model, that has really cooled. That was 2014, 2015. Investors now are looking for some sort of proof that a company can make money and make money at scale.
Seems only necessary, really, doesn't it? Wonderful to have you here. Thank you so much for talking us through it. And I'm sure many people will be getting their teeth into this particular index that Goodwater have created. Goodwater Capital co-founder and managing partner Chi-Hua Chien joining us. Now, coming up, US stocks are in tight trading range, but there are some standouts making big moves in the tech sector. We'll have the details next. And a feature we'd like to bring you to your attention is our interactive TV function. You can find it at TV Go on the Bloomberg. You'll not only be able to watch us live, but also see previous interviews from Bloomberg coverage around the globe and dive into any of the securities like that startup barometer we used on Bloomberg Functions. You can, of course, have this for only the Bloomberg subscribers, though, I'm afraid. Check it out at TV Go. This is Bloomberg. Now, a story we're following for you. A federal judge has blocked a Seattle law that allows Uber and Lyft drivers to unionize. The U.S. Chamber of Commerce had asked the judge to block the ordinance before it goes into effect, arguing that the rule improperly treats independent contractor drivers. Uber and Lyft are members of the Chamber of Commerce. The city of Seattle, on the other hand, says, well, collective bargaining would create a safer, more reliable industry. Meanwhile, Tuesday was a pretty tight trading session in the United States. For the majors, the Nasdaq barely moved the needle, but there are some standouts in the session. Let's get into them with Bloomberg News stocks reporter Abigail Doolittle, wrapping up the trading day as well as always. Abigail, and give us a sense of what really actually was on the move.
Well, Caroline, it was really a very quiet day overall for the major averages. As you mentioned, we had the major averages of the Dow, S&P 500, and the Nasdaq all finish higher fractionally. This after whipsawing between very small gains and losses on the day. One of the smallest trading ranges on the year, in fact. So let's hop into the Bloomberg and take a look at BTV7467. Each of these yellow bars represents the full trading range on the day for the Nasdaq this year, and we can see that today's range is below that pink line, one of the 10 smallest ranges this year. So again, investors really don't have a lot of conviction, at least today, after some of the volatility that we've seen in some of the other sessions represented by those bigger bars. Where we did see some action, though, both Amazon and Alphabet. Amazon finished up more than 1.7%. Alphabet finished down 0.5%. This after BMO cut Alphabet to a market perform from an outperform, basically saying that they see headwinds for Alphabet from Amazon relative to ad revenue growth. So pretty interesting there. And the firm BMO, Dan Salmon, the analyst there, also saying that Amazon is his top pick in that big internet space. Now, speaking of that big internet space, it is absolutely on fire this year, Caroline. Let's hop back into the Bloomberg and take a look at BTV6742. This is the FANG trade this year, with the exception of Purple. That's the S&P 500. All these other stocks are Facebook, Amazon, Amazon, Netflix, and Alphabet. And in that order, really, too. Up top in yellow, we have Facebook. In blue is Amazon, up 20%. Netflix, up about 17.5%. And then Alphabet, up the least, up about 7.8%, but still outpacing the S&P 500. So even with this cut today and also the ad issues that Alphabet has had more recently around YouTube, although coming up with a solution, those shares are still outpacing the S&P 500 in the year. And again, this FANG trade, Caroline, alive and well once again.
Certainly is. I mean, we'll have to keep on calling it FANG, even though they have rechanged themselves to Alphabet. How dare they mess with our acronyms. But give us a sense also of Monday, of course, taking it back. It was a big story that the Apple suppliers were under pressure after we saw that huge move for imagination technology in the UK. But Tuesday, did we get a feel that any of that was still being wrung out a bit?
No, that actually really pretty much went away. And in fact, we did see an upgrade over at Pacific Crest that helped for both Cirrus Logic and also for Skyworks, two of those Apple suppliers that did fall in Monday's session after Imagination Technologies plunged 60% on the news that Apple will be cutting them off over the next 2 years. The analyst there at Pacific Crest, he is saying that channel checks show accelerating growth. And interestingly, on the same day, Pacific Crest, another analyst over at Pacific Crest, actually cut the shares of NVIDIA. They're recommending that investors instead go into Skyworks. That stock, NVIDIA, down sharply on the day, down about 7%. So lots of movement once again for the chip stocks. And overall, Caroline, the SOX, or that semiconductor index, was down about 0.5%, certainly outpacing a bigger move, I should say, than the overall small gains for the NASDAQ overall, Caroline.
Great roundup of all US moves by Bloomberg News stocks reporter Abigail Doolittle. Thank you very much indeed. Now coming up, US tech giants are looking to gain ground in India. But is it a bit too little too late? We are going to continue our coverage of the tech landscape in the country next. This is Bloomberg.
I'm Elisa Parenti, and you're watching Bloomberg Technology. Let's start with a check of your first word news. Marine Le Pen supporters would pick Emmanuel Macron as their second choice, even though both have clashed on major issues. That is according to a French public opinion poll, which found among those backing the far-right candidate, 27% picked Macron as their fallback candidate. Ecuador's National Electoral Council says incumbent party candidate Lenin Moreno has won the country's tight presidential election. Challenger Guillermo Lasso had been contesting the results, alleging electoral fraud. He is also asking supporters to take to the streets in protest. The AP reports Russian investigators believe a 22-year-old suicide bomber born in the former Soviet Republic of Kazakhstan was behind yesterday's deadly bombing on the St. Petersburg subway. Officials say the death toll stands at 14, including the bomber. Britain's Theresa May wants to increase trade and security ties with Saudi Arabia. She's on a 3-day trip, first to Jordan and then to the Saudi capital. May brushed aside calls from lawmakers to suspend arms sales to the Saudis because of the kingdom's airstrikes in Yemen. U.S. Homeland Security Chief John Kelly says arrests of people illegally entering the U.S. across the Mexican border plummeted last month. Kelly says fewer than 12,500 people were caught. That compares with more than 58,000 he says were detained in February. That is the lowest monthly figure in at least 17 years. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Elisa Parenti, and this is Bloomberg. It's just after 5:30 p.m. Tuesday here in New York, 7:30 Wednesday morning in Sydney. I'm joined by Bloomberg's Paul Allen with a look at the markets. Paul, good morning.
Good morning. We're a little under 2.5 hours away from the open here on the ASX, and futures pointing up. It's looking quite positive, up about 1/3% right now. The Aussie dollar slipped back a little on Tuesday. This is after the Reserve Bank of Australia issued its statement when it held the country's cash rate at that record low 1.5%. The RBA Governor Philip Lowe gave a speech later that night in which he had a few things to say about lending practices at the banks, particularly the number of interest-only loans going to housing investors. Over in Japan, Nikkei futures are looking kind of mixed, and it might be worth keeping an eye on China Southern's Hong Kong listed shares. China Southern holding a press conference today. We may learn a little more about the American Airlines stake and also the good earnings, the good profit that China Southern reported last week. That's just some of what we're watching around the region today. I'm Paul Allen in Sydney. More from Bloomberg Technology next.
This is Bloomberg Technology. I'm Caroline Hyde. And our top story this hour, fallout from new guidelines for the US work visa program. Shares of Indian-based outsourcing firms that use those H-1B visas fell in Tuesday trading. One example, Infosys down over a percentage point, and Tata Consulting also down 1% on concerns that changes may impact their hiring costs. Now, while some of the biggest Indian tech companies are under pressure, US tech giants are still eager to get into the market. Joining us now is Brian Nieder, partner at Lead Edge Capital. Lead Edge is a multi-stage growth equity firm that manages over $1 billion in assets globally. Brian, welcome to the program. And first of all, I want to get your take on some of the bigger tech giants that we've seen, Apple over the weekend, Amazon and the like, all trying to get into India to varying degrees of success. Who's got the right tactics here?
Yeah, look, I think that there's a lot of companies trying to make their way into India, and I think that over the last couple of years, you've seen a little bit of a decline in the venture capital markets in India, meaning that a lot of the financial players are pulling back slightly because of things like cash burn. That being said, some of the larger players that are larger global companies like the Amazons, Apples, and Ubers of the world are making their way into India. And the reason I think that they can do that is because their time frames are extremely long. So a lot of these companies don't have a 2, 3, 5-year time frame. In fact, they have a 10 or 20-year multi-decade type time frame. And in those circumstances, they could actually play there. And so you see Apple, as an example, trying to get into the smartphone market. It's difficult because a lot of the folks in India don't have as much money to spend on smartphones, and obviously the Apple phone is much more expensive than some of the lesser priced Android units. But they're trying to make their way there. And then Amazon, for sure, they've spent a lot of money and a lot of time building out their practice over in India. So if you look at what's gone on, there's Flipkart, there's Snapdeal, but Amazon has been the one in retail that has really taken the lead with massive spend. And so about 3-4 years ago, they pledged to spend $2 billion in the region. Last year, there were a lot of news reports that said that the $2 billion had been spent and that they pledged another $3 billion over time. And the reason why they want to do this is because India is really one of the last great frontiers out there. Some of these companies might have lost out in China. They feel like growth is tapped out potentially in North America. And they see India, a country with a population of 1.2, 1.3 billion people, as a way in which to continue to bolster growth and ultimately make a profit.
I mean, Amazon maybe felt it lost out in China to one of your own portfolio companies,
Sure.
which is Alibaba. How much do you think Alibaba will directly enter India, or will it remain an investor in startups in the country, but perhaps not go directly in to tackle the market?
Yeah, that's a good question. I think that so far they've spent their time and their capital as becoming an investor there. They made an investment a couple of years ago in Snapdeal, which I think is one of the main competitors in the online retail market over there over the last several years. They also made an investment over the last few years in a company called Paytm, which is a payments platform. And so I think that, and Paytm, by the way, is rumored to be getting into e-commerce. And so I think that from our perspective, most likely they're moving in as an investor, and as the market continues to mature, I think that potentially they could move in as an independent entity. It's not something I would rule out, but it's unclear at this point that they'd be anything more than just an investor, given that that's where they've played so far.
And of course, you mentioned Uber before, another company that you play heavily with as well. Sure. Have they been taking the right tactics in India? Because in many ways they've gone against some of their usual playbook, and they've been accepting cash and the like. Do you have to bend some of your rules to be able to make things work in India? I
think that the market there is just incredibly different, and if you look at the the wealth of the people there and how they pay for things and what the logistics systems are like, it's very different than what we know in the United States or in Western Europe, which is that so much is done in a cash-based society. And so a lot of the folks there, you look and you say, look, they have 1.2 billion people, many of them must have credit cards. That's not the case. And so Uber needs to adapt to their local geographies in certain circumstances, and India certainly is one of them, where they have to look themselves in the eyes and say, okay, look, maybe we have to deviate a little bit from our typical playbook, but that's okay because the prize at the end is large enough for us to want to capture. And so I think that what they're doing there seems to make a lot of sense in terms of bending what they would normally do to do things like taking cash.
Yeah. But the prize for you in India, you obviously have portfolio companies that have exposure to it, but you haven't actually delved in hook, line and sinker into the Indian market, unlike the likes of Sequoia and Nexus, who we spoke to yesterday. Why not?
Sure. We've spent a lot of time in India and have traveled there extensively and spent time with a lot of entrepreneurs. I think that ultimately we as a firm have made global investments quite a bit. So we've invested in Asia, certainly in China. Alibaba's our largest investment that we've ever made. We've invested in South America. We've invested in all throughout Europe. Our concern about India was a couplefold. Number one was just the dispersion of wealth there. And so you've seen a lot of businesses. I saw you talking earlier about some of the IT outsourcing businesses. Some of these are very, very large businesses, obviously, that serve the rest of the world. But when you look inward in India and you look at companies that are serving the consumers and the constituency of that country, you have to look and say, okay, well, what is the wealth effect there? How wealthy are the people that will actually be buying goods and services within India? And when you look at that, it's a little bit misleading because in some circumstances you look and you say, gosh, there's 1.2 billion people like we spoke about before. On the other hand, when you look at sort of gross national income per capita and you take the total income of the country and you divide it by the number of people, you're talking about that the average income for a person in India is something like $1,500. And the average income in the United States, as an example, is about $54,000. The average income in China is like $8,000. And so when you look at those numbers, you say, how is there material spending capacity for all of these billion people? And for us, it's a little bit of a concern that the market might not be there quite yet. Over time, it could continue to grow, but right now, that's how we feel. The other thing that I'd point to is cash burn. It's just the businesses have been spending a lot of cash on building, and oftentimes the unit economics just don't work at this particular juncture.
Brian Nida, great expertise on India, partner at Lead Edge Capital. We thank you for your time today. Now coming up, AOL CEO Tim Armstrong on what his company will look like once the merger between Verizon and Yahoo is finalized, and details on that newly announced division called Oath. This is Bloomberg. Verizon will introduce a new division called Oath this summer. It's a debut that coincides with the telecommunication giant's merger of its AOL unit with Yahoo's internet assets. Now, AOL CEO Tim Armstrong announced the news Monday on Twitter, saying the new unit will oversee more than 20 brands, reaching over 1 billion consumers. He touted the launch on Bloomberg Daybreak Americas.
We're launching much like a Berkshire Hathaway or Procter & Gamble. We have a B2B brand in Oath, which is a value-based brand that allows us to highlight. It actually clears the lane for us to really promote Yahoo and AOL and TechCrunch and Huffington Post and MoviePhone. So it's really a values-based brand. It's long-term. Some of the reaction you see to the brand, I think, is very short-term thinking, and we're a long-term company. We've done really long-term strategies. So we're big believers in brand and huge believers in long-term commitment to talent, which is what Oath is about.
Yeah, besides being a great executive, you're also pretty good at marketing. And boy, get this much attention, this much.
People have been saying, how much did they spend on this?
There's some free advertising going on here.
We basically have not. We developed a brand in-house. Last 24 hours, we've probably gotten $50 million worth of brand marketing for it. So when we go to launch our brand campaigns for Yahoo and AOL, those things will be free and clear. So it's turned out to be even though it got leaked, it's turned out to be a huge benefit for us.
So apart from the branding and the marketing, how's it going? I mean, exactly how is this merger going going to work as you internalize Yahoo. And the main question I always ask is, can you run up against your old shop of Google and Facebook? Because really, somebody's going to have to take them on at some point.
Right. So I would say this, David, is, first let me start with Verizon. Verizon has a long-term strategy in the media space. Overall, we were the first acquisition they did. Yahoo is the next one. So we're going to touch over 1 billion consumers. I think we're in a very good position to launch what I would say the largest house of trusted brands in the digital space. Google and Facebook and Amazon are all partners of ours. Overall, we're focusing on the business model side on brand advertising. I've done advertising for 20 years. I was at Google for 10 years. I see an open lane and space in the brand advertising space, and that's where we're going.
Is Marissa Mayer going there with you?
So we are, right now, the executive team is Marissa, plus me, plus both sides of the executive team, planning all the executive outcomes that will come in terms of leadership, which we'll announce during Q2. So I would just repeat what Marissa said and what I've said before is that Marissa will stay through the next phase, and the next phase of the business will be a mixture of the two executive teams together. So I would look for more information in Q2 around that.
That was AOL CEO Tim Armstrong. Oath, it seems, all PR is good PR. Now, sticking with the web, President Trump has rescinded a rule that requires internet service providers to ask their subscribers permission before using their web browsing history for marketing. Now, I spoke earlier with Tim Berners-Lee, the founder of the World Wide Web, of course, and asked, well, what his thoughts were on the signing of this new bill.
I think it's a step in a very bad direction. I think it's a step in a disgusting direction, in fact. And I think it really suggests a lack of appreciation of the core values, which are core, the international values, the human values, they're core American values. They're core Republican values too. So it's a bizarre way to go. In fact, it is just a step. It's a sort of an indication of a direction.
Because some of the reaction to this, of course, was that the internet service providers, the likes of AT&T, perhaps were being unfairly treated when the internet juggernauts such as Google and Facebook, ruled overseen by the FTC, are allowed to use our data, perhaps without getting us completely to sign away the agreement to that. Do you think that some of the internet giants should have to go through more rigorous testing when it comes to use of our data, or is that the quid pro quo to having free services?
Yes, it is a good idea for the internet giants like the big social networks and the search engines to be subjected to serious constraints over user privacy and user data. That doesn't mean that they're the same as AT&T or Comcast. AT&T and Comcast, their job is to deliver the bits.
When you see the unfoldings of fake news, which is now so prominent in our discourse, is this something that you ever felt the World Wide Web would be in a state of at the moment? Is this something that you think is being reacted to in the right way?
Well, I have to say that 2016 really changed my attitude. So for 25 years since the web started, I'd assumed that those of us who do things with the web and the internet just tend to make sure that the internet is a platform, an open platform, the web is another platform built on top of that. It should be solid, it should be neutral, and then if you give humanity a good, open, solid, non-discriminatory platform, then humanity will go ahead and do good things. And look, we kept it open, we got lots of innovation, and we got Wikipedia, and we got OpenStreetMap, and we got all kinds of great things. But then 2016, I think actually is not sufficient to just leave it open and let whatever happens on the social networks happen. So I think that now, no, we have to look at the social networks, and people who build the social networks have to look at them and think about the effect that they are having, the emergent effect that they are having on humanity.
Where does the World Wide Web go from here now with the rise of artificial intelligence? We are now using devices at home. You talked about, of course, Internet of Things. We're talking and using voice search now. Where do you think we can see the World Wide Web progress to?
In a way, I've always said that the next thing around the corner, it's really important that those of us who work on the current technology can't even imagine what's going to come. So to a certain extent, that's the case with artificial intelligence. I think there are some things which, like driverless cars, will be really valuable. The moment they become safer than people driving, then that will have a massive effect. There's another thing when the AI starts doing the jobs which make the decisions, when the AI starts to become a judge, when the AI, for example, when it's inside a social network and it's deciding what's a good news story for you to read, already it has a lot of power. So when that sort of thing starts being done by AIs, then a lot more interesting questions, more serious questions about what's happening to society and to what extent human beings are in control of it. And I think the questions that people like Elon Musk and Bill Gates are asking about what happens if the AIs get smarter than us, I think those are good questions to ask.
That, of course, was Tim Berners-Lee, founder of the World Wide Web and newly announced winner of the prestigious Turing Award, often referred to as the Nobel Prize of Computing. Up next, a Chinese conglomerate which grand plans to be the next Tesla, Netflix and Apple all in one, but it's facing a serious cash crunch. Details next. This is Bloomberg. Now, Mercedes-Benz parent company Daimler and Bosch are teaming up. The world's largest luxury car maker, of course, Mercedes-Benz owner, and the biggest auto component producer, Bosch, want to put driverless taxis on the streets of the United States and in Germany within 6 years. The pact between the two forms a powerful counterweight to new auto industry players like ride-hailing giants Uber and Didi, which are also working on self-driving vehicles. Now, a cash crunch at the Chinese tech conglomerate Leeco continues. According to people familiar with the matter, the company delayed paying its US employees this month. It's the latest sign that billionaire Jia Yuting may have overreached in his plan to create a US foothold for the internet media empire. Bloomberg technology reporter Selena Wang was first to report the story and joins us now from New York. I urge all our viewers to go to thebloomberg.com and read it. It's a great piece, Selena. And this is a man, a billionaire, who wanted a media and an internet empire to outdo Baidu and Alibaba, and it looks like he's having a few problems.
This has been really fascinating company to track. I attended their grand unveiling just in October about their huge U.S. strategy. They bought this enormous plot of land in Silicon Valley. They said they were going to hire more than 10,000 employees. And now this, month after month, we've seen a severe cash crunch. We've seen suppliers actually allege that they missed payments. We've seen them be stripped of sports broadcasting rights. This is really a story of a company that went too far, too fast. And sources have been telling me that this has stoked a lot of frustration with the U.S. employees. There were a lot of promises that weren't actually given, and delaying payroll for employees is always a very bad sign. And though the company told employees that this was due to troubles getting money out of China, a lot of my sources tell me that they believe there were a lot of other issues involved here as well.
I mean, the company has responded saying actually that the payment wasn't missed, but I mean, you know differently. And indeed, what therefore do we think in terms of the high-level employees they had managed to lure over from big tech giants such as Samsung in the US, and now they seem to be looking for the exit?
Definitely. I mean, they hired a number of very high-profile executives from Qualcomm, from Samsung, and 2 of the 4 main executives they've hired have actually left, all within the span of less than a year. He also has this other division called Faraday Futures. It's another one of his big ventures in electric vehicles. And that part of the companies has seen significant turnover, especially in their U.S. finance team. Most of them actually left at the end of last year. They've started to rehire some folks to that team. But sources tell me that it was very frustrating for them because at the end of the last year, they told the CEO, Jia Yuting, we can't keep on spending and spending. And he said, keep on going. The money will keep on coming. And obviously it didn't. So that also stoked a lot of frustration, which caused a lot of turnover.
They seem to be claiming that they're beefing that team back up, and certainly in the finance side of things, making a key hire from a bank. I mean, what can we actually begin to believe here? And really, should we be looking also at the money that they have managed to bring in? Because they did try and get some cash to come from Sunak, didn't they?
YT, another name that the CEO goes by, he is very good at fundraising money. He's been able to continually raise money. As you mentioned, he recently got this large over $2 billion lifeline from Sunak, and that really is supposed to help alleviate some of these problems. But one of the issues is that most of this money is coming from China. They have ambitions to raise money in the U.S. and eventually list in the U.S. In order for U.S. investors to feel comfortable investing in this company, they really need to start cleaning up the situation, getting some cash flow. As far as we know, the only profitable entity is the main publicly listed one in China. And with Faraday Futures, as you said, what can we expect from them? Well, hopefully the new CFO is able to bring in a new team to fix some of the problems, but they don't really have a real product out yet, so there's not very much to go off of at this point.
Selena, we'll wait for your next installment. Fascinating reporting from Bloomberg technology reporter Selena Wang there. Now that does it for this edition of Bloomberg Technology. Wednesday, we speak to Brian Taylor, partner at TPG Capital, for an exclusive interview about Intel spinning out its cybersecurity vendor, McAfee. That's all for now, though, and this is Bloomberg.